Hello and welcome. In this video we are going to code and analyze a very simple trading strategy on Bitcoin in 2023 with some interesting if not exciting results. So first of all, the strategy, very straightforward. You are buying when the Bitcoin is climbing by more than 2% over the last 12 hours. Then you are setting a target profit and stop loss on X%. So for instance 1%, meaning Bitcoin was rising by 2% over the last 12 hours. You are selling when it is climbing by another 1% after that, or it is falling by another 1% after that. We are also testing the vice versa strategy. So we are buying when the Bitcoin is falling by more than 2% over the last 12 hours. And we are again setting a target profit and stop loss on X%. We are doing the whole chain of coding the strategy, so this video is going to be very interesting. We are taking a look at data handling, so data pulling via the API, data manipulations, strategy setup and backtest, parameter playarounds, and we are also discussing the model or strategy downsides. Important disclaimer, concepts shown in this video are not an investment advice. Video is for educational and informational purposes only. Additional disclaimer, there are a couple of simplifying assumptions which will be discussed in the course of the video. Alright, let's get started. We need some libraries, pandas for data handling. From the Python Binance library, we need the client. So from Binance client, import client. That makes pulling data using the API very convenient, so I recommend doing that using the Python Binance library. We need NumPy for calculations, e.g. calculating log returns. And I'm also going to instantiate the client. Next, I'm going to pull Bitcoin price data on the 1 hour interval using a certain function. And as I've covered this function in many of my previous videos, I'm just going to copy paste that from my other screen, but I'm going over it step by step. So this function, get data, is taking a certain symbol, in our case the Bitcoin in relation to the US dollar or the US dollar stablecoin equivalent USDT, US dollar Tether. Also takes a starting date, in our case simply 1st January 2023 of this year. This one here is taking the client, which we have instantiated here, takes the get historical k-line function or k-lines function, which is pulling candlestick data or k-line data for the given symbol on a given time interval, in our case 1 hour, from a certain starting point on, so in our case the 1st January. The data frame function is just wrapping the results here in a convenient data frame, so we can do the data manipulations. And this line here is simply cutting off unnecessary columns. So only the first 6 columns are relevant for our analysis. So the rest is just being cut off here. As the columns currently are named using integers, so 0, 1, 2, 3, 4, 5, 6, and so on, I want to give it a name here, or want to give the columns a name. So I'm renaming the columns to what they actually are. First value is time, open, high, low, close, volume. How can I know? It's in the API documentation. So this is just a column renaming thing. And then the data frame currently has an integer index. So I want to have the index of the data frame as the time values. So I want to have a data frame where I have an open, high, low, close, volume column and the time as the index of that column. Of that data frame, sorry. So this is simply setting the index to the time column, and this is just replacing the current index, which is an integer index. Then, as the time value, which is the index now, is a Unix timestamp. That is just a very, very large number, which is only machine readable. I want to make it human readable. So I'm using the pandas to datetime function on that index, define the unit as ms, so I'm getting a human readable timestamp. As the values coming as string values from the API, I'm transforming them to floating values. So this just being applied to open, high, low, close volume. Just by the way, you don't necessarily need volume data here. I just kept it in, but it's not relevant for this video, this strategy, or this model we are setting up. Then we are returning the frame and we have it. So let's actually just call this function. I recommend to execute it line by line outside the function so you see what each steps are doing. When I'm calling this function, get data and provide Bitcoin USDT and the starting date, which is the 1st January 2023, and store that in some variables. So let's take the F here for that. I'm getting 1 hour granular Bitcoin data, which you will see in 1 second, or maybe 2, for the open, high, low, close volume values. So you see it's going from the 1st January and then hourly until exactly now. So we have 7.9k rows. So this is 1 hour granular Bitcoin data. Now, what we are going to do with this is just coding our strategy, and this time I'm not using a vectorized approach or something like that. I'm just using an iterative approach. So we are coding the strategy by looping over this data frame. Before starting to loop, we have to set up some things. First of all, we need the 12-hour change here, right? And to calculate the 12-hour change, I'm calculating the hourly change first. So the hourly change is simply the change on the close column here. So we are calculating that and adding a new column, which I'm just going to call change, so CHG here. And I'm simply taking the close and then percentage change. To make things easier, I'm taking log returns here. Why? Because they are time additive. You can also use raw returns, but then the calculation is a bit different. I will link a video from some of my previous videos where I'm using raw returns here. So the adding part is only possible with log returns. So I'm using log returns here. So this is the change. Now I want to have the log return and not the return here. So I'm using numpy's log function on the percentage change plus 1 here. In case this is not intuitive for you, if you just take the close, divide it by the shifted close, and then take the log, you will get the exact same results I'm showing you here now. So if I'm just copy pasting that, mathematically this is the exact same here. All right. So this is just the change between 2 rows and then taking the log, and this is the change between the rows in percentage plus 1 and then the log. So mathematically exactly the same. Anyhow, so this is the log return in our change column. So our data frame is just looking like this. We have our hourly changes in each row here. All right. And now we just need the 12-hour change. And as we have log returns, we are just rolling over this column with a 12 time steps window and take the sum. We can only do that because these are log returns. Remember that. If you want to use normal returns, you have to take the product instead. So 12-hour change, also new column here, 12-hour change. Simply take the change column, roll over it with a 12 window and take the sum. So this is looking like this. So of course, for the first rows, you have NaN values. We want to get rid of them. So I'm just using drop NA and replace the current data frame having those NaN values. So this is simply looking like this. So we have our 12-hour change in this column here. There's just one more preparation we need to do before looping, and that is having a realistic buy price. Now imagine you have a 12-hour change here. This 12-hour change includes this close price, right? At the end of this hourly window, so this one here, you have this price, and the close price here on this row is flowing into the 12-hour change. So we cannot, whenever, let's just say this is more than 2%, we cannot buy on this close because we only know the 12-hour change after we know what the close price is. So it's impossible to buy on the close here. So this is very important, called forward-looking bias. So we have to tackle that. And what we're going to do is, once we have the 12-hour change, we are buying on the next, I'm missing the word, on the next hours open. So simply on this one. So when we have a close here, and just imagine this is 2%, we buy on the next candles open here, on this one. So I want to add a column here, which is simply having those values shifted one row back. So we have a realistic buy price. And I'm just calling that buy price. So calling that buy price, and take the open, and we are just shifting that one row back. So if we would have a 12-hour change large enough here, we would buy for this price, which is exactly the next candle's open price, or next hour's open price. All right. And you already see that this can be a big difference here, right? So we wouldn't be able to buy on this close, but the next price would be higher than this price, which also would have an impact, or already would have an impact for our P&L. But anyhow, these are all the necessary preparations for our data frame. You can optionally also drop this NaN value here, so just execute that again, or execute that after you've done that here. So I'm just executing it again, so we don't have it. All right, so this is our data frame, and the next thing we're going to do is simply loop over it. And let's do that from scratch first. So let's just define a position flag, which is taking care of if we are currently in a position. So of course we are in a position when the 12-hour change is above 2%, and then we buy Bitcoin, and when we bought Bitcoin, we are in a position. So once we're in a position, we have to check the target profit and stop loss condition here. So let's create a position flag, which is just storing that information and is always updating it whenever we are entering or exiting a position. So initially, this is false, of course. We are not in a position initially. And I'm also going to store the profits somewhere. I'm just going to store them in a list. And this is just keeping track of the profits of each trade. Now, let's populate this profits list. And I'm going to loop over our data frame. So for index row in df iteros. And then I'm checking if I'm not in a position, if not in position, which is initially the case. Then I want to check my buying condition. And my buying condition is simply if my row 12-hour change value is larger than 0.02. So if that is larger than 2%, I want to buy. So I'm storing my buy price, and my buy price is my row's buy price. We have just defined that above, which is the next hour's open, as a recall. And when we bought, we are in a position. So we are setting the position flag to true. And then we need a if we are in a position check. So if we are in a position now, so if in position, so when this value is true, which is being the case when we bought the Bitcoin, then we are checking our selling conditions. And instead our selling conditions are target profit, stop loss, right? So first I'm checking the target profit. If, and now let me check the data frame again, because this part is very important and you should consider what I'm saying now and also do the improvements I'm suggesting, or let me know if you want to have more content on that, because it's really important. Now what we are going to do now is we are checking if the high value of an hourly window is touching our target profit. And we are also checking if the low value is touching our stop loss. All right. Now this comes with a quite obvious problem if you think about it. How does my trading logic know what was happening first? How does it know this was before this one? And this is a big problem because we are missing data here to prove that or to check that. And this is a big downside of this approach because you need more granular data. Using the API calls, you can go back until 1 minute granular data. But even taking 1 minute granular data, you would still have this 1 minute interval uncertainty. So you always don't know. So the probability, I can tell you that this is happening, the probability is very low, right? So because of the movement window of 1% up and 1% down. But it can happen. And if you take 1 minute granular data here, you still have that uncertainty. So the 100% bulletproof way would be to run a trading bot or a trading strategy simulation using live data, a live data stream, and checking it in real time what is happening with the price. And then store it in some data storage, be it an SQL database or a CSV file or whatsoever, or a data frame, wherever you want to store it. But this would be the bulletproof way. So if you take real-time data and check what is actually happening first, right? I have done that. I think it's like 1 or 1.5 years ago. I will do an updated video on this if the interest is high enough. So let me know. But keep that in mind. So this is a huge downside of the strategy. And the higher your time interval is, the higher the probability that this is giving you wrong results. So this is giving you something which didn't happen in reality. Or it happened, but it happened after the other event was happening. Keep that in mind. Very important here. So we are checking for the target profit first. If my high value is larger or equal to my buy price times my target profit. So in our case, let's start with 1% here. So if my high value is crossing the buy price times 1%. So if I bought the asset for some amount and then it's worth 1% more, then my target profit is crossed and I can sell the asset. So this is what this one is doing here. So then I have a sell price. And in this case, my sell price is my target profit here, right? So I don't have to jump to the next row because whenever this price is hit or this target profit is hit, I'm selling for this target profit. So my target profit is simply my buy price times the target profit, which is in this case 1%. And now I can calculate a profit, because for what I sold the asset for and what I bought the asset for, if I have the differential between those, I have my profit. And the relation of this differential to my buy price, so what I bought the asset for, is my relative profit. So my profit is my sell price minus my buy price in relation to my buy price. And that is my relative profit of that trade. Then I'm just appending this profit to my profits list. So if I would touch my target profit with the first trade, then I would have a profitable trade here. After that, I'm setting my position flag to false again, as I'm not in a position anymore after I sold. Excuse me. Next, stop loss condition. So if that is not happening, but my low value is below or equal to my buy price times my stop loss threshold, so in this case 99%. So same concept as here, checking my stop loss threshold using taking a look at the low of the hourly candle. Then my sell price, same story. I can copy paste and just take other values here. So stop loss threshold, so 99%. And then exactly the same concept here, right? Profit is sell price minus buy price in relation to buy price. Then profits, append profit, and then position flag false. And that's already it for the loop of this strategy. We are doing some fine tunings in some seconds. Be a bit patient here. So when we're running this loop, we would know for this year, 2023, when I buy the Bitcoin after it was rising 2% within the last 12 hours and sell it, placing a target profit of 1% and stop loss of 1%, how much profit I would make, taking no capital restrictions into account. That is another downside of this strategy setup, because we are just assuming we are just investing the exact same amount every single time this signal is occurring, which might also be a bit far from the truth, because if you make losses, and let's say you invested 1K, then you won't invest 1K the next time anymore, right? Then you will invest whatever amount is left for you. But anyhow, let's run this and take a look at somewhere I messed up here. 12-hour change. Yeah, okay. 12-hour change. It must be, as I named the column, 12-hour change. Sorry for that. So loop went through. So let's take a look at the profits. So obviously you are getting either a 1% loss or a 1% gain here, right? So this is how your profit structure is looking like. Quite some trades here. You could argue, well, you need to take some trading fees, some slippage into account. Yes and no. So slippage, yes. Bid-ask spread, yes. But trading fees, rather not, because on Binance you can trade the Bitcoin for free. You don't have trading fees. But if you want to account for trading fees, you would need to subtract the trading fee here. So for Binance, buy and sell amount for, let's say, ETH would be 0.15%. But I'm not doing it here as we are working with Bitcoin. But keep in mind, there's also some room for some potential slippage here. So these are our profits. So what we need to do here is to just cumulate them here, right? So these are not log returns. These are just raw returns. So we would just need to take the products out of this list here. So how can we do that conveniently? So we're just taking a panda series on those profits, so it's not in a list structure, so we have an easier time calculating the overall return, or the cumulative return is the proper word here. So we are transforming that to a series. Then you can also, by the way, calculate the win rate to see what is the percentage of successful and unsuccessful trades. I'm not doing that for now. So we have the profits here. Then we need to add a 1, take the product, and finally subtract the 1. So what does this value mean? If you would follow this strategy, so buying the Bitcoin after it was rising by 2% and selling it with a 1% target profit and 1% stop loss, you would lose 36%. So the strategy is a disaster. All right. Now the question is that strategy really that bad? Maybe the target profit and stop loss corridor is just not large enough. And you could test that, for instance, by just manually amending the parameters here, which would be really bad. We are tackling that in 1 second, but I'm going to show you the result for now. So if we extend that corridor, and this is kind of the point of this video, to provide some parameters to see how the strategy would look like. So if you do that with a 2% corridor, you would get a strategy win of 7% here. So if you would extend that furthermore with, let's take 3, you would get a 4% win. And now we are getting to the interesting part. What are some maybe better thresholds here? So maybe 3% is a bad idea. So we are going to refactor this loop here, put it all in a function, and then we are running some parameters through it and see if we are getting better or interesting results here. So to refactor that, it's actually quite straightforward. So you're just taking all the code here in it and be a bit creative. So you're just indentate that by 1 line. Then you make a function out of that. And this function is just calculating profit. So I'm just going to call that profit calculation. This is taking a certain change, which is this change here, so currently 2%, and it's taking a target profit and a stop loss. All right. So now you simply replace those manually added values here, take change here. Here you take target profit, and here you take stop loss. I'm keeping them separate here so you can play around with an unbalanced target profit stop loss ratio. So maybe you want to check 3% target profit, 2% stop loss, and so on. So I'm keeping them separate and not connected to each other. So the whole profit calculation you have to do within this function, so it directly puts you out the cumulative profit of your strategy. And once you found your parameter windows and you want to take a closer look at the trades, you can still do that, right? You know the parameters, and then you can run it like this, take a look at the profits, or you can just pull out the trades out of this function. For now, I'm just taking the cumulative profit out of this function, but do your individual amendments as always. So this function should return the cumulative profit of the profits array. So I'm just going to copy paste here. So prof calc, let's execute that. Messed up somewhere. Yeah, didn't use a colon here. Now if I'm calling this function for the same parameters as I was just using, I'm getting the same results. So if I'm taking a profit calc here, take the change of 2%, target profit of, I think I took 3% here, as far as I remember, and 79. Yeah, I'm getting the exact same value, right? So now I can play around. So 4, and 6. And now I'm getting this quite insane cumulative profit of 60%. And now, excuse me, got a bit of a cough here. So next interesting question would be to pass an array of parameters, right? So as always, do your own stuff, right? You would be interested in. I'm just giving you some inputs here and some ideas. There's a lot more to check out here. So let's pass some parameters to that and see if we're getting some interesting results. So I need a parameter of stop losses, and let's take an array of values from 1% to 15%. So I'm just going to create an array here, calling that array, use numpy arrange, and take 0.01 as the starting point and 0.16 as the ending point, as I want to go to 15%. And as you know, Python doesn't count the last or the stop value. So this is just going until 15. Then the step size is 1. And this is pretty nice. You're just getting an array containing what you want to check. And these parameters you just pass to the function here, right? So you can do that, e.g. using a loop again. So for element in array, just print out what element you're currently checking. So 4 plus string ele. And then you want to have your profit calculation function called, take a change of 2%, and then 1 plus the element for the target profit. So in this case, I want to multiply with 1.01. And the stop loss, I want to take 1 minus 0.001. So in the 1% case, I would get 1% rise and 1% fall afterwards. So simply 1 minus ele. I'm quickly showing you how this is looking like. So 1 minus array, I'm getting my stop loss thresholds here. You see 99%, 98%, which I'm using to calculate my stop loss value by simply multiplying the buy price with it, or same for the target profit. So multiplying by this, multiplying by that, and so on. So this is what I'm doing in this loop here. So if I'm executing that, I'm getting some interesting results here. Oh, this is bad to read. Wait a second. So for 1% target profit, stop loss, I'm getting an insane loss, which is already quite interesting to see. Then it's getting a bit better, but not significantly. But from a certain point on, so if I'm taking 4% here, I'm getting 60% returns, then I'm getting 110% returns. And this is being, from this 0.04 point on, this is being quite constantly better, or in this range of over 100% return, until it goes further down when you are getting into a too wide corridor here, right? But you see that this already shows you some interesting view here, right? So you can, of course, add another parameter, which is the change window. So if you take, you can also pass that as a parameter, of course, here. If you take 3% increase now, you see that the 2% might be the better choice in the first place, right? So this is only showing 2023. Of course, check that for 2022 and stuff like that. But this is already showing you a very interesting picture here where you can do further research on. So 2%, and then those two parameters, you see that this is giving you quite some insane results. Now, what if you just do it the other way around, as I said in the beginning? So if I'm passing 2% loss here, and I have to amend that in this function as well. So I have to check the change being smaller than 2%. So if I have a drop of 2%, then I'm changing it here. Of course, you can also extend this function and provide two more conditional statements. So if my provided change is negative, then I want to have this a smaller sign. If my change is positive, I want to have this larger sign. Also an extension potential here, but I'm not doing that for now. I just want to quickly show you how that looks like. So in other words, what we are comparing here is a short-term momentum strategy with a short-term reversal strategy. So let's take a look at what results we are getting here over this array of target profit and stop loss values. So we're executing that, and then we pass this minus 2%. So let's see. And as you see, we are getting positive cumulative returns, but they are way worse than the ones with the short-term momentum strategies. So this is short-term reversal. And if you change that again here, this is short-term. I have to execute that again, sorry. And this is short-term momentum. So this is just scratching the surface, but I think you got the point. So for future content, what I think would be very interesting and valuable would be to run a real-time backtest in quotation marks. So a real-time trading simulation, taking real-time data feeds into account and see if those short-term momentum, short-term reversal patterns are existing in the cryptocurrency markets. So leave it a like. I hope this video was interesting for you. I thank you very much for watching, and I'm looking forward to see you in the upcoming videos. Bye bye.